All right, thank you all very much for joining us here for the webinar on this Tuesday afternoon. Today we're going to be discussing the recent partnership that we have with KraneShares and NASDAQ Dorsey Right with the model that was recently became available here on the NASDAQ Dorsey Right platform. My name is Ian Saunders, and today I will be joined by Brendan Ahern of KraneShares. He is the CIO of KraneShares, in charge of their research. Prior to joining KraneShares, he was one of the pioneers in the ETF industry, as one of the first 20 employees of iShares of BlackRock, and it was able to see the hyper growth of the ETF industry firsthand through that experience. As the CIO of KraneShares, he has frequently visiting China, and is also authors the China Last Night blog, which I'm sure he'll get into a little bit, and which everyone should subscribe to as well. Today, he'll start things off first with an overview of the current state of investing in China and how KraneShares approaches that environment. And then that'll be followed by an overview of the model that we have partnered to bring to you, and some implementation ideas for that model as well. So without any further ado, Brendan, feel free to go ahead and take it away.
All right. Thank you very much, Ian, and thanks for everyone for joining us today. I'm just going to dive right in. Very much appreciate the time everyone's taking today. So just very briefly about KraneShares is we are focused on new China thematics as well as the opening of China. So as an entity, we've created a suite of exchange-traded funds around this idea of China's evolving its economy away from manufacturing to a consumption-driven economy, and secondarily, that China is providing increased access to foreign investors, and that's going to really have a very dramatic effect on portfolios over the next decade and further. But most importantly, we're really focused on research that based on what we see happening and what we'll discuss today, there's going to be a lot more China coming to indices. And we endeavor to earn your trust, that you're going to have a China expert within your staff or that you can rely on. And we at KraneShares want to earn that trust. And so today we're going to talk about what we see happening around China today. We've created a suite of China and emerging market ETFs. But I think the great thing about collaborating with our friends at NASDAQ Dorsey Right, having attended a advisor conference with DWA down in Richmond, not quite 20 years ago. I don't want to date myself, but I got a very early indoctrination in the point and figure methodology, and big fan of Tom, Ian, and the rest of the Dorsey Right team. So I'm just so excited that we're able to take our products and apply it to the Dorsey Right methodology. I think that's the beauty of the model, is you don't necessarily have to become an expert in each of these products, that you can really rely on the model. And so we're very, very excited about our partnership with Tom, Ian, and the rest of the Dorsey Right team. So with that said, if we're thinking about China, like why should we even be thinking about China or emerging markets? Well, I just wanted something that I've been thinking a lot about, is that every morning one of our institutional trading partners, they send out a morning note, and they say every morning the S&P is not overvalued, but if we look at 2020 earnings per share estimate on the S&P 500, today that's at $178. And we multiply that by the current PE ratio, we get to about 3,000, just over 3,000 on the S&P 500, which is exactly where we are now. Now, U.S. corporations, the U.S. economy have done just absolutely fantastic over the last decade. We've had a great corporate earnings. We've had a low interest rate. The U.S. dollar has been quite strong. And so that's a great tailwind. Obviously, buybacks, right? Amazing the amount of buybacks that we've had. And I don't think that necessarily changes But I think it is worth a pause to be thinking about rebalancing outside of the U.S. And emerging markets kind of jumps to mind. Obviously, Europe, negative interest rates, Japan, negative interest rates. It's a fantastic way to implode your financial sector. I think there is an argument for be looking at emerging markets. Now, when we think about emerging markets, why do we think about emerging markets? Well, it's due to the rise of the consumer. It's about positive demographics. It's about the adoption of technology. As people get wealthier, not only do they spend more money on goods, they do more so on services like education and healthcare. At the same time, if you buy broad-based emerging markets, I call it buying the blob. What is the blob? What are we buying? Well, I would argue that a big element of the blob of broad-based emerging markets, about 25% is in financials. We've got another 20% to energy, industrials, and materials. So about half of emerging markets are in low to no growth sectors. So we have a rationale for buying EM, which is about growth. And yet we're buying in broad-based EM, buying the blob, we're buying something that is value geared, higher dividend, low growth. I think the blob is a poor transmission vehicle for why we buy it. Now, of course, we all know that over the last decade, the S&P 500 has performed just spectacularly. Since the March 9th, 2009 low, the S&P 500 is up 476%. The end reality is the more that we've diversified away from U.S. stocks, the worse we've done. Emerging markets is only up 191%. But at the same time, I believe the broad-based emerging market benchmark, the blob, is really a value play. It's a value play from a sector exposure, financials, energy, industrials, materials. Throw in a commodity bear market. Is it any wonder that broad-based emerging markets has underperformed the growth market taking place? Now, within emerging markets, there are growth sectors. So what about technology? What about EM tech? So since the March 9th low, the S&P 500 is up 476. Broad-based EM, MSCI emerging markets, is up only 191%. Emerging market technology is up 548%. If you've owned the right part of EM over the last decade, you've actually outperformed the S&P 500. Now, the problem is, within that broad-based emerging markets, less than 15% of our exposure to the best performing sector, the technology sector. Now, I can't predict if value will come back. I'm not saying that you rush out and sell all your broad-based EM and buy growth EM, but I think there is an argument for owning an element of your EM exposure to more of growth orientation. And that is where China comes in, because that EM tech is predominantly China. And I think, there's a few things that we as investors, if we trade based on what the media is telling us, particularly around China, we've not done a very good job. Because whether or not you own KraneShares, there's a lot happening in a positive way around China. And I think the things that would surprise most investors is that this chart looks at inflows into China's mainland market, the Shanghai and Shenzhen stock exchanges, as well as China's bond market. Now, both China's on mainland, the A-share market is actually the second largest stock exchange taken together globally, but so is the bond market. The bond market is the second largest in the world. But we've had very, very little exposure because historically they limited the amount of exposure. But over the last five, 6 years, we've seen a dramatic opening up, and we're seeing money go into China. Just on this week, Monday and Tuesday of this week, foreign investors have put over $500 million into mainland Chinese stocks. We're going to talk about why that's happening. So money is going into China despite all these headlines out there. Someone is allocating. Now, one of the things that's difficult about China, this is an element that I love about the Dorsey Wright model, is that part of China is doing very well. Look at this top part. If you've been invested in these Chinese A shares, you're actually invested in one of the best performing stock exchanges in the world, mainland China. Look at this MSCI China A. As of last night, of this morning, it's 26.7%. But if your definition of China is Hong Kong, that's actually only up 6% year to date. That's the largest China ETF here in the U.S. is up only 6%. So navigating China can be very difficult. The U.S. listed Chinese companies, they're actually up over 20%. So you have this very vast dispersion of performance because how we define China helps determine our outcome as investors. And what's happening in Hong Kong in terms of these protests, that's really weighed down the Hong Kong market. And if that's your definition, you're not having a very good year. But if you've been geared to more of the growth, internet and e-commerce companies, you're having a good year. If you're actually allocated to MSCI's definition of A shares, you're having a very good year. So even navigating China as an investor can be very difficult. Ultimately, that is a big part of our value add here at KraneShares, is to help you navigate that. Now, the third thing happening that you need to be aware of is next Tuesday is MSCI's semi-annual index review. MSCI, their indices are followed by 14.8 trillion of both active and passive assets. So in following, knowing what MSCI is doing is very, very important. Now, within MSCI emerging markets, that has about 2 trillion benchmark to it, both active and passive. Next Tuesday is when they rebalance their indices, which means several of the largest EM ETFs have to change their composition. So this is what the pro forma for next Tuesday night's trade is going to look like. And you can see that China is a big part of it. On a free float market cap, that the weight of China increases to 33, over 1/3 of the index. But I think it's important that if we look at the number of stocks in MSCI emerging markets, the pro forma for next Tuesday night's trade, at the end of next Tuesday, there'll be 1,412 stocks within MSCI emerging markets. 712 of them will be Chinese companies. 712 of the 1,412 will be Chinese companies. South Korea it's down to 111 stocks. Taiwan, less than 90. India, like 70 stocks. Brazil's the fifth largest country. India's less than 8, it's about 80. Brazil, the 5th largest country in EM, will be 55 stocks. China's 712. So there's a lot more China coming, and again, this is why we endeavor to earn your trust, because you're going to have to make some decisions about this. Now, you might want to say that's just too much, Brendan. That's China, 1/3 of the index, over 50%. Maybe you want to hold EMX China. We actually listed such an ETF earlier this year. But what's happening in China? Well, you can't talk about China without talking about the trade war. Now, when we sat with Dr. Henry Kissinger, we asked him, what do you think about the trade war? And he said, Trump's tactics in terms of tariffs are unorthodox and effective. And he's correct. If we actually look at what is being tariffed, those goods are less of them are coming here. Ultimately, tariffs are a tax paid not by the Chinese, but by U.S. consumers. And this is low-end manufacturing. These are your kids' toys and car seats. And the price of those goods will go up, and China is making less of them. Now, you'd probably say, well, that's going to really hurt China. But China, what's important is the trade war is hurting part of China. Part of China is very manufacturing geared, and that part of China is being hurt by the trade war, which is why China wants to get a deal done. But what's interesting is that by hurting China, which is the middle person in the global economy, as the middle person in global trade, the trade war is like throwing sand in the gears of a machine. And what we've noticed is, when did global PMIs peak? February 2018. What happened then? The first trade tweet. Why is Japan and Europe falling off? It's because the trade war is creating a global malaise. What are the two of the worst performing markets globally year to date? It's not China. It's South Korea and Singapore, because they're global trading hubs. This is why you're seeing a pivot from the U.S., is that in order to avoid a recession before the election, we have to come to a conclusion. We have to solve this trade war, which is why the media doesn't believe it, but I believe a trade resolution, at least a phase one, is occurring now. Now you could say, well, we don't need China, but ultimately U.S. firms have invested very heavily in China. That these plants that make these goods, in many cases, are owned by U.S. companies. And that's why you don't see these companies, they need China in order, because of the basically the low end. Now you can say, well, why don't we just manufacture this stuff in here in the U.S.? Well, 100 million Chinese are employed by manufacturing companies. The labor participation force in the United States is 130 million. So if we all want to go work in a factory, that's what we'd have to do to bring it back here. So you might say, well, send it to Vietnam. The more manufacturers are, there's more Chinese in manufacturing than the entire population of Vietnam. It's literally impossible for Vietnam to take over Chinese manufacturing. So it can't come here. It can't go elsewhere. The other thing that is that U.S. companies are making a lot of money in China. Apple sold $11 billion worth of iPhones last quarter. Nike would have missed their earnings if it wasn't for China. Their global sales grew like 4 or 5%, but their China sales grew over 20%. In the case of Daimler. Daimler sold more Mercedes-Benz in China than both the US and Germany combined. You're starting to understand that there's a consumer. This is what the media misses, that the consumer is now the biggest part of China's economy. Manufacturing has dropped from 35 to under 20% of their GDP. The service sector is over 50%. We think of China as manufacturers, but the reality is even the October retail sales grew 7.2%. We just had Singles Day. Singles Day in China, the Chinese sold, Alibaba sold alone $38 billion worth of goods. Their competitor, JD.com, sold $20 billion worth of goods. This company called Pinduoduo didn't release their sales. I think they probably did 20 billion. But from November 1st to November 11th, it's estimated over $100 billion worth of goods were sold during the Singles Day sale, China's big kind of Black Friday, Cyber Monday sale. So the consumer is alive and well, and that's why we as investors have been very focused on the internet and e-commerce companies that act as the transmission engine for domestic consumption as it occurs online. Alibaba alone grew revenue 39.78%. There is one company in the world that has grown revenue over the last 3 years over 30% and has a market cap of over $300 billion, and that is Alibaba. And yet, we'll show Alibaba is well off its all-time high, but many of the companies geared to the consumer. JD, their rival, they just grew revenue 28%. A little company called Vipshop was just about 10%. A lot of the online video companies, a company called Bilibili, they reported earnings last night after the close. They grew revenue 72%. Their rivals for online video, Hua, YY, grew revenue 68, 67%. You cannot find growth companies growing faster than the companies geared to the consumer, which is why over 6.5 years ago, we listed KWEB, a basket of Chinese internet and e-commerce companies. But those companies, because people say there's a trade war happening, I can't hold China during a trade war. It's created, we believe, a great value opportunity. KWEB within the Dorsey Wright model went to a buy very recently. I'm sure Ian will speak to that, but we think it's a compelling opportunity to buy these growth names within China today. Now, what's growing this internet e-commerce in China is the adoption of the mobile phone. And that's something that's happening within the broader EM space. And that's why we listed an EM version of KWEB called KEMQ. And that goes into the Dorsey Wright model as well. Now I mentioned that you've got this huge dispersion between what within the China universe. KWEB is up 21%. FXI is up only 6%. So you have to look very carefully on these different exposures within what you own, right? That a lot of these definitions are old China. But what's important is that MSCI will continue to add Chinese A shares, that after next Tuesday, its orange slice is MSCI's definition of Chinese A shares, and they're slowly being added to MSCI indices. We know that they're adding pieces of market cap, but at full inclusion, these Chinese A shares alone will be 17%. Remember, Korea will be just over 11%. So Chinese A shares alone will be much larger than the second largest country in China. Now, there's more than one definition of Chinese A shares, but MSCI is making their definition look very, very different from other indices. That their definition of Chinese A shares at the end of next Tuesday increases to 472 stocks, which makes it look very, very different from other benchmarks. So you have to choose wisely when thinking about Chinese A shares, which is why we listed MSCI's exact definition Chinese A shares back in 2014. Ultimately, because of this MSCI inclusion of Chinese A shares over the next 3 to 5 years, China is going to go from 1/3 of MSCI emerging markets to well over 40%. I think this actually underestimates how big China is. Its capital markets so much larger. Remember, China will be 712 of 1,400 stocks in EM. Brazil will just be 55. South Korea is 111 stocks versus China. So ultimately, KraneShares, with our singular focus on China, we endeavor to earn your trust around understanding what's happening in terms of China's economy, capital markets. We do so through research. We do it on a daily basis in our China Last Night blog, but we also do bigger research pieces about twice a month. So again, we believe that there's a lot of positives happening, but most importantly, what gets me excited is that if you believe like I do in the Dorsey point and figure methodology, you can allow the Dorsey Wright point and figure methodology to dictate what you own within China. And I think that's great opportunities there within healthcare, internet, these Chinese A shares. So with that, I know we've gone over a lot. Obviously, you have our email address. So if there's any follow-up questions, we're always available. And with that, I'll hand things back off to Ian.
Perfect. Thank you very much there, Brendan, and a wonderful run through of the China kind of market environment. And as we're jumping in here to the model, before we do so, I do want to make sure to mention we will have time to open it up for questions here towards the end of the webinar. So if you do have any questions, please do hold them until the end, either for me or Brendan or both of us. And we will make sure to have some time for you to utilize that Q&A feature on your Zoom screen. So looking at the KraneShares Dynamic China Rotation Model, the name of the model that we have recently partnered with KraneShares to bring to you. Before we jump into that here, looking generally at Dorsey Wright, right? Some of you are subscribers, some of you may not be. Dorsey Wright, Nasdaq Dorsey Wright, is a technical analysis firm. It's a technical research firm with most of our research centered around the concept of point and figure charting and relative strength analysis. And that's simply an objective way for us to determine the strength of the security from a point and figure perspective, and then how strong that security is relative to maybe its peers, relative to the market, but from an objective point of view. The only input that we have that goes into this calculation of strength is price. And so this price actually works in this price movement that we're able to track as we've proven to work very well here in domestic markets. But it's also worked very well in international markets. The price really does not have a language barrier. Looking specifically at a price and how it moves over time can be done across any market, whether it's here in the US or whether it's in China through a vehicle with KraneShares there as well. So looking at specifically the implementation here with the model with KraneShares, we use what we call a relative strength calculation to determine areas of strength and then move out of those areas when they become weak. And how we get at that calculation is simply taking the price of an investment, divide it by the price of another investment, multiply it by 100 simply to move the decimal place over, make a number easier to work with, and that gives us what we call a relative strength of reading. And so if you think about your given sports analogy, right, we're in the middle of football season, two teams are going to be playing each other playing each other this past weekend. NFL is continuing here this next weekend. The teams are going to play each other each game in order to determine a winner. And so if you think about this calculation here, as investment A rises faster than investment B, then security A would be winning in a relative strength matchup against investment B. On the flip side, if investment B is rising faster than A, then investment B would be winning that matchup, winning that arm wrestling match. So all we're doing from a relative strength calculation perspective is simply stacking securities, stacking things up against one another to see, okay, is A rising faster than B? If so, then that's going to indicate a period of outperformance, and that will change when we begin to see that calculation fall when B begins to outperform A. And so we take that reading each and every day, and we chart that on what we call a point and figure chart in order to determine who wins and who loses that matchup. So you can compare any two things with a price, whether it's two stocks, let's say Apple and Microsoft, A and B, to KraneShares ETFs, to market representatives. Let's say we were looking at stocks and bonds. That's what this RS chart that you see here in front of you is going to be looking at. So if you're not familiar with point and figure charting, as a brief overview, the chart that you're going to be looking at there on the left-hand side is again going to be charting that RS calculation between SPX, between stocks, and between a broad domestic bond representative, AGG. And so looking at that comparison, stacking those up against one another, when you see that the chart is in a column of O's falling, that indicates that bonds are going to be outperforming stocks. On the flip side, when it's in a column of X's rising, it's indicating that stocks are going to be outperforming bonds. The important thing to keep in mind here is, again, looking at those signals. So sell signal is going to be indicated by the column of O's moving beneath the previous column of O's. And you see that those initial sell signals are typically going to be followed by consecutive sell signals. And when our relative strength chart moves to an RS buy signal, then typically that will be followed by consecutive buy signals. So we're looking to use the signals to identify those longer periods of outperformance. But in looking at those, you see that no strategy is perfect, that this isn't every time you see a sell signal doesn't necessarily lead to consecutive sell signals. A great example that we see there in February of 2016, and the relative strength chart did move to a sell signal against the market. And you can see by the performance comparison there that it did end up being a false signal, that stocks did end up outperforming bonds over the period that the relative strength chart was on that signal. But the important thing with this relationship is that the relative strength chart corrects itself very quickly. So we saw that corrected. And looking at the longer term period of buying, holding the S&P throughout the period of this test from November of 2000 through September of 2019, had decent returns. You were up about 125%. If you simply bought and hold AGG over that time frame, a little bit worse returns, up around 40%. But using this relative strength switching strategy, buying the S&P when it was on a buy signal and buying AGG when this relative strength chart was on a sell signal, even with that one period of false signal there, still led you to significant outperformance over the long run, up over 300%. So when we are looking to bring this relationship to the KraneShares lineup, looking at building an inventory, we wanted to have a flexible inventory that was liquid enough to be used in these individual relative strength charts. So specifically looking at really four main areas within the KraneShares lineup: the China thematic, which is going to be those more sector-focused areas using KWEB, KURE, the China All Healthcare ETF, and then the KraneShares China 100 Leaders ETF as well. The China Core, giving that core exposure there, looking at including the A-shares ETF that Brendan mentioned there, especially pertinent with the inclusion into the MSCI index is coming up here very shortly. And then KALL as well, the All China Index ETF, as those kind of potential core components that could come into the model. Then we have the emerging markets thematic, which are more broader emerging markets potentially being included, but each of those ETFs is going to be heavily overweighted towards China relative to the other emerging market countries within the funds, at about a 40% exposure specifically to China within each of those funds. And then finally, we do have the China fixed income representative as well, KCNY. which is the China Commercial Paper ETF. Including this gives the model the potential to become defensive in periods of heightened volatility for Chinese equities. And emerging markets in general is really known for its volatile environment. So any way that we're able to mitigate that volatility, to reduce that overall volatility in your portfolio is really a benefit to you, to the investor. And so how that is going to be done in this particular model is looking at including the China fixed income as a way to smooth out the ride during periods of heightened volatility. So looking at how the model is actually going to be constructed, we take those seven Chinese equity representatives, and we compare each of them on one of those individual relative strength charts against the China fixed income representative, against KCNY. So each of the seven funds stacked up against KCNY on that arm wrestling match. With those funds that win the arm wrestling match is indicated by a relative strength buy signal on our point and trigger chart, moving into the model as a holding. And then those positions are going to be sold when they move to an RS sell signal against KCNY. Now, the model is going to seek to remain fully invested in China equity. And as you can see from the current allocations here, each of the seven funds actually can pass that relative strength test. They win that arm wrestling match against KCNY, indicating broad strength of China equities relative to the fixed income representative there. But if volatility was heightened, if we started to see that those funds move to sell signals, those positions are going to be sold again when they move to an RS sell signal. And if only three or fewer funds pass the relative strength test against KCNY, against the fixed income representative, then KCNY will actually move into the portfolio as a holding in an equally weighted fashion. So this model is going to be evaluated weekly. It does use total return data as well, as an aside. And again, when an addition or deletion is made either from an equity side or with KCNY being included, the portfolio is going to be rebalanced to equal weight. So as an example of how we transition to defense, we have a hypothetical allocation here. Let's say that we're at week one. We have 4 equity funds that are currently passing against KCNY from a relative strength perspective. 4 equity funds have indicated positive relative strength against that fixed income benchmark there. So the portfolio is 100% exposed to equity, 100% equity. Week 2 comes and we see that now only 3 funds pass. We see KCNY moves into the portfolio as an equal weighted holding. So 25% fixed income, 75% equity there with the 3 equity funds that pass against the fixed income representative. Week 3 comes, now only 2 funds pass against KCNY. This would have a 66% exposure to equity, 33% exposure to fixed income. Week 4, only 1 equity fund passes against KCNY, so the portfolio is split 50-50 between China equity and China fixed income. And then on a hypothetical week 5, KALL moved to a sell signal as well, so the portfolio moves to 100% fixed income exposure. Now, this is again just a hypothetical example of how the portfolio can transition from being 100% China equity to 100% China fixed income. One of the important things here with the portfolio is that it is always going to offer that exposure to China. So it's not going to be moving you out of China and into cash. You're always going to be remaining invested in the international space. It's just a matter of only being in China equity when it is designated to have positive relative strength against the fixed income. And we do see, although this is just a hypothetical example, we did see in the back test that we've done with the model, the portfolio did actually move to 100% fixed income in the back test during August of 2011. And then we saw it become more defensive as well in August of 2015 with the heightened volatility in China to move to a 50-50 split there between 50% equity and 50% fixed income. So while the portfolio is 100% invested in the all seven equity funds passing that relative strength test currently, it definitely does have the capability to move towards that fixed income exposure with the potential to move to 100% fixed income there. So looking at actually implementing the model and actually how you can see the model here on our platform, logging in, we have an area on the platform called the models page, which brings you to a line that you would see that looks similar to the one here in front of you. Gives you the basic information, the symbol for the model we have on the site, the name of the model when it was first published here on the site, as well as some more near-term performance information. You can see that stacked up against our broader China benchmark there, FXI.TR, the TR designating that it's a total return performance that we're looking at there. The model does perform across each of the performance comparisons, and we have it outperforms across each of those examples. The information file button that you see there gives you a 2-page document that gives you some methodology explanation on the first page with some further performance information on the second. But actually, to look at the holdings, you would click on that holdings button here, and it would bring up a page that you would see like the one directly in front of you. Tells you when the funds within the model were purchased, what the original price was, the current price, and the percent weighting that would be held accordingly. Again, the portfolio is going to be rebalanced, but only upon a change. So it would be rebalanced equally weighted upon a change, and then we would let the portfolio run from there. So we did see the last change come in with the 7th fund passing that relative strength test in the beginning of this month on November 4th. KMED, the Emerging Markets Healthcare Index ETF, did move to an RS5 signal against KCNY, became a member of the portfolio to move to all 7 equity funds passing. You can also set alerts on model changes on our platform as well using the set alerts button that would be found in the upper right hand corner of the models page. And that way you would be able to come in, see the current holdings, go ahead and purchase those holdings within your trading platform from there, and then set an alert on the model, and you wouldn't necessarily have to come back in and check it until we sent you an email to make a change. That way it gives you time back in your day, which is always of increased importance here as the current state of things is. So looking at further growth in the more near-term performance information that was available there on the models page, and we see vast outperformance of the model throughout the entire history of the test compared against the benchmark here, looking at over a 200% return from the initial starting date of the test at the end of 2008 up until last Friday. Models up just over 200% at 200.67, vastly outperforming the benchmark FXI.TR over that time frame, which is up just over 80%. But the important thing to note here as well is those periods in time when I mentioned before that the model did transition to more of a defensive posture in 2011, 2015. You'll notice that you're looking at a smoother ride throughout those time frames as well. You're not going to reduce all of the drawdown, but it's an easier drawdown to take there, smoothing out the ride over the entire time frame of the test, paired with that outperformance. And we see that in some of the further evaluation of the performance data that we have, looking at quarterly data as well as the cumulative numbers that we see here in front of us, specifically looking at the KraneDynamic.TR versus the FXI.TR here. The net numbers are going to assume a hypothetical 1.5% management fee for those advisors that might apply a similar fee for their clients, just to give you some perspective or give your clients some perspective on what returns might look like to them. But looking at the actual model return, KraneDynamic.TR, we see again significant outperformance through the end of the third quarter, paired with that vastly lower standard deviation to really indicate to help mitigate that overall risk in your portfolio. As emerging markets can be a very volatile space, again, anything that you can do for your clients to mitigate that risk, to reduce that portfolio volatility is going to be a benefit to them. So that was one of the main goals that we had in looking at this model. Yes, we wanted to have higher performance. We wanted to have as high returns as possible, but really reducing that portfolio volatility to smooth out that ride over the long run is going to be of heightened importance there as well. And it's a very positive sign that we see that did occur in the history of the back test that we have. So looking at some potential ways that you can implement the KraneShares model here into your portfolio. While Brendan and I'm sure both of us would hope that you can go ahead and throw all of your international exposure towards this model, your compliance department might not like that too much. And so looking at more of the typical breakdown that we see in the emerging markets exposure from a benchmark like we have there with EEM is typically around 30% exposure towards China. And so you compare this model with the KEMX, that emerging markets ex-China fund that Brendan mentioned earlier, looking at a 30% exposure to the model, 70% exposure towards that fund. Just as a hypothetical example to match up with the exposure in EEM, make that more palatable for maybe your clients or for the compliance department there to offer exposure. This is what a hypothetical portfolio would look like. We don't have necessarily back testing available with this specific example due to the very recent launch of that KEMX fund. But just as a way to bring this model into your portfolio, at least from an initial perspective, could be one potential use case that you have here. Again, looking 30% within the model, this would be the hypothetical allocation from an equally weighted fashion with the 7 funds that would be included. And then you have the 70% left over with KEMX. Gives you the way to still maintain that similar allocation that you would currently have with just a broad-based benchmark, but now you have that tactical approach to the largest member of that emerging markets space, with which China is relative to the other countries within those broad benchmarks. Gives you that tactical approach to be in the areas of strength as long as possible until they begin to show weakness, while still maintaining that China exposure through the fixed income there. So with that here, have the wonderful disclosures that my compliance department has told me are the most important slides to have in the PowerPoint. And we can go ahead and open it up for questions. I did see that did figure out the Q&A button as well as the chat button there with the technical difficulties. So any questions, please do go ahead and shoot away either to Brendan or I or both of us using either of those options there. So I did see an earlier question on here from user cannot print the symbol list. So this that list, you can definitely print it there from our website if that was what you were referring to there. You can view the full inventory of the model, and then you can print that out from that page, from the web page there as well. See another question pop up here as well. Is a single ticket ticker available for trade like other Dorsey models, example DWTR? So being as this is a very new model that we have here on the site, it is not available in a single CUSIP form. So in order to file the model, you would need to have a subscription there to the website, which you can definitely get a free trial of if you don't have access to it currently. But you would log into the platform there. You would see the holdings of the model in a similar fashion, the way that they are displayed, and then simply set alerts and wait for there to be an email for a model change.
Yeah, and hopefully, with if adoption of the model continues, that's an evolution. I know, Ian, you've seen, just from say with First Trust and others, that if there's a strong adoption, we would definitely consider, listing such a single, an ETF off of the model for sure.
Absolutely. Just because it's not here now doesn't mean it might not be in the future, right? But yes, absolutely. So maybe potentially.
Okay. So yeah, I see that Darren, a question just around the I think we've seen two almost separate things. The federal thrift savings plan, which is the primary retirement plan for federal employees. The trustees recommended they switch their benchmark. Historically, this federal pension plan had only access to developed markets, so Europe, Japan. It actually had no emerging market exposure. By moving to the world West, that includes EM and China. And there's been, there's talk of, that certain politicians didn't like that idea The trustees recently came back and rejected that they said that, obviously, China is just one part. They didn't really give too much. It was more about a diversification, and that, China is a big part of the global economy and part of emerging markets. Again, this was a all country US, so I think China was less than 10% of that benchmark. I mean, my thought was, ultimately, the government can say that they don't want, this particular MSCI benchmark. That's their decision. Obviously, politicizing the investments of a pension plan doesn't sound like a great idea to me. But time will tell. I mean, certainly the government, has that ability to decide what their allocation is. I guess ultimately we as taxpayers are on the hook, for not holding EM. Saying that, there was talk about limiting the Chinese companies listed here in the U.S. Floated this idea maybe about not quite 2 months ago. The S&P 500 lost 70 basis points in the final 2.5 hours of trading. That equals a loss of, based on the S&P 500, 25 trillion in market cap. U.S. investors lost $250 billion, just on the idea of implementing what really is capital controls. The 1.2 trillion of market cap from Chinese companies listed here in the U.S. Is held by U.S. investors. So I think it's you're not really hurting China if you don't allow Chinese companies to come here. Ultimately, the U.S. is a global financial hub, and if for political reasons you start determining who can and can't come, I think that's a very bad sign for U.S. Financial markets. That we would lose that status. It's China today, but who's next? I think companies would move away from the U.S. Investors outside of the U.S. I think it would have a very negative effect for all U.S. investors if foreign capital started to leave the U.S. So it's two separate issues. I think it's unlikely that that prohibiting companies from coming here would happen. It's a shame that U.S. asset managers and broker dealers didn't push back. Ultimately, they do benefit from this, but I think they wanted to avoid the political spotlight. So time will tell on both, but it's a lower probability. In the very short run, the Congress could pass a support bill of Hong Kong. I think that's actually a negative for Hong Kong. Hong Kong has special trading status with the United States. Excuse me, and I just think you'd ultimately hurt Hong Kong's ability to trade with the United States if it comes under political scrutiny. Despite wanting to help Hong Kong, I think it would actually have the opposite effect. But again, we're investors, we're not politicians. Ultimately, we're very much geared on these growth companies. And if anything, when you go to China, when you see what's happening there, I think more communication is better, not less. Stronger economic ties is a good thing, not a bad thing. And I think some of the media hyperbole is very much detached from the reality of what's happening there. And I think that's a shame. It's a very bad thing if the U.S. and China diverge. Ultimately, our economies are so intertwined. I don't think that decoupling is feasible. But again, I think it's very hard to say what's what some of these politicians what their true motives are. So time will tell a little bit. Hopefully that answers your question, Darren.
And I will say as well, on kind of piggybacking onto that from our technical perspective here, I mean, the fact that we've seen further follow through to, even with these headlines, further follow through with each of the securities now being, each of the potential securities in the model moving into the holding, giving those relative strength buy signals, at least indicates a kind of continued strength for the time being too. So.
Yeah. I mean, I do believe the model coming back into some of the equity geared ETFs is a pod. The timing was very, very good. And I think as much as the media, the media is creating all this sensationalism and apocalyptic, I think it's why people subscribe, to Dorsey Wright. The X's and O's are emotionless, and I think as evidenced by the inflows, strong performance of mainland China, as well as this MSCI, it shows you that there are positives. The media hasn't caught on to it, but I think our views are very much aligned with what the model is telling you as well, for what it's worth.
It's always good when the fundamentals and the technicals align, right?
Yep.
So, any other questions? Please do continue to utilize this Q&A feature or the chat box, whichever one from those. So, question here: where and how can I use the RS signal? So the relative strength signal that we have there is something that's actually going to be taken into account here that we would do for you, right? So we would compare each of these representatives that would be potentially held in the model, and compare each of those against the fixed income representative that we have. That's something the model is going to do for you. So as long as you would set an alert on the model through our platform, you would get an email if there's a change to any of those relationships. If you did want to implement or take a look at those signals on your own, you can definitely do so through our platform there. I won't take a deeper dive into that here now for the sake of time, but absolutely, if that's something that you want to take a look at, please do reach out to us as well, and we're more than happy to help you out. If you are a subscriber, to help you out with a walkthrough. If you're not, to get you on a free trial there and get everything squared away. And you can find us at, don't believe it was mentioned here, but at DorseyWright.com. We'll take you to a login there to be able to get on the platform. All right, so we'll probably leave it open for another minute or so here. If there's any other questions, please do continue to utilize the Q&A or the chat box. And after another minute or so, we will go ahead and wrap it up. So please do go ahead and shoot away questions if you do have any. All right, so with that, not seeing any more questions here and seeing some participants get into drop off. So we can go ahead and wrap it up here. Thank you very much here for joining here, Brendan, and taking us through the model with the examples there. And I do apologize again to everyone for the technical difficulties here. We will have a replay available of this webinar, minus the technical difficulties in the middle. We can take that out. So we will have a replay available as well as the slides, both Brendan's portion at the beginning and then the model slides there at the end. That will be sent out or made available there as well. So again, thank you very much here, Brendan. Anything else you wanted to mention here before we sign off?
No, very much appreciate the opportunity, Ian, and looking forward to our partnership together.
Wonderful. So we are very much looking forward here on our end as well. We thank everyone very much for joining us here on this Tuesday afternoon. We will be back in touch with the replay and the slides. And if you have any other questions, please do reach out to us here on the model.